All right, class, welcome. In this explainer, we're going to tackle a topic that is absolutely fundamental to your study of taxation, and that's rental income. Getting this right is crucial, and I can pretty much guarantee you'll see these concepts again and again in your careers. So let's really dig in and make sure we understand it.
Today, we're breaking down all the essentials of how to report rental income here in Canada. And our primary source, our roadmap if you will, is the Canada Revenue Agency's T4036 guide. It's the official rulebook on this, so we're going to walk through it together, step by step, to make sure everything is perfectly clear. So here's our game plan. We're going to start with the most basic but most important question. What kind of income are we even dealing with? Then, we'll get into the nuts and bolts of calculating it, what you can deduct, and how depreciation works. That's CCA. And finally, we'll look at a couple of really common real-world scenarios, including some brand new rules you need to know about. Okay, first things first. Before you even touch a tax form, before you calculate a single dollar, you have to make this distinction. Is it rental income or is it business income? Because getting this wrong at the start can cause major problems down the line. It dictates everything that follows.
So how do you decide? What's the test? Is it about how many properties you own? Or how much money you're making? Nope. According to the CRA, it all boils down to one simple thing: the level of service you provide to your tenants.
And this slide lays it out perfectly. Think of it this way. If you're just providing a space to live, the basics like heat, parking, maybe a laundry room, that's property income. But if you start offering additional services, things that make it feel more like a hotel, like regular cleaning, security, or providing meals, well now, the CRA is likely going to view that as a business. And that means a whole different set of tax rules apply. Okay, so let's say you've determined its property income. Great, step one is done. Now we have to figure out the gross rental income. And you might think that's easy, just add up the rent payments, right? Well, it can be a little more complicated than that.
And this is a really important point. Income isn't just cash or a check. It can be anything of value. If your tenant is a painter and they paint the unit instead of paying rent, you have to include the fair market value of that paint job in your income. Also, notice we use the accrual method. That means you report income in the year it's earned, so December's rent is 2024 income even if your tenant doesn't pay you until January 2025.
This is a fantastic, classic example right from the CRA's guide. So, Sonia gets Glenn to plow snow in exchange for a rent reduction. Here's how it works. She still has to report the full rent she would have charged. Then, she reports the value of the snow plowing as other income. Now, here's the other side of the coin. She can then claim the value of that snow plowing as a maintenance expense. See how it works? It's a wash, but you have to report both sides of the transaction.
Now we're getting into what is, without a doubt, one of the most confusing areas for landlords and one of the most common places for errors on a tax return. It's the difference between a current expense, which you deduct 100% this year, and a capital expense, which you have to deduct slowly over many years. This distinction dramatically impacts your net income. This table is your absolute best friend for figuring this out. You have to ask yourself these questions. First, what's the benefit? Is it a quick fix, like a coat of paint? That's current. Or is it a lasting benefit, like brand new siding? That's capital. Second, what's the effect? Are you just restoring something to its original condition, like fixing a broken step? That's a repair, a current expense. Or are you improving it, like replacing those old wood steps with brand new concrete ones? That's capital.
And here's a perfect example that brings that concept to life. Patching a few leaky spots on the roof. You're not replacing the whole roof, you're just putting it back in working order. You're restoring it. That's a classic current expense. Now, if you decided to tear off the entire roof and put on a brand new, better one, well, that's a whole different story. That would be a capital expense. So, all this talk about capital expenses leads us logically to our next topic. If you can't deduct the cost all at once, how do you deduct it? Well, you do it through something called capital cost allowance, or CCA. You can think of CCA as the tax system's word for depreciation. The CRA recognizes that things like buildings and appliances wear out, so they let you deduct a piece of their cost each year. But, and this is an absolutely critical rule you have to remember, you cannot use CCA to create a rental loss or to make an existing rental loss bigger. You can only use it to reduce your net rental income down to zero and not 1 penny more.
So let's look at a few common CCA classes. The big one, of course, is the building itself. For most rental buildings bought after 1987, they fall into Class 1. This gives you a CCA rate of 4% on a declining balance. That means each year you can deduct 4% of the remaining undepreciated cost of the building.
But what about the things inside the rental? The stove, the fridge, maybe some furniture you provide. Obviously, those don't last as long as a building. So the CRA puts them into Class 8, which has a much higher CCA rate of 20%. This lets you write off their costs much faster, reflecting their shorter lifespan.
And here is a rule that trips up so many people, so please pay close attention. It's called the half-year rule. In the very first year you buy an asset, whether it's the building or a new appliance, you can generally only claim CCA on half of its value. The CRA basically assumes you bought it midway through the year. It's a general rule, there are a few exceptions, but you need to have this one on your radar.
Let's shift gears now to a scenario that is incredibly common in Canada. What happens when you rent out a portion of the home you actually live in? Like a basement apartment or a spare room. How on earth do you handle the expenses?
You have to split any expenses that apply to the whole property, and you have to do it on a reasonable basis. A square footage or room count basis is usually what the CRA likes to see. So in Patrick's case, he rents out 3 rooms in his 12-room house. Simple math, that's 25%. So he can deduct 25% of his shared costs like property taxes, utilities, and home insurance. Now, for any costs that are 100% for the rental portion, like advertising for a tenant, he can deduct the full amount.
All right, let's wrap up with something that is brand new and very important for the 2024 tax year and beyond. This is a huge change that directly targets the short-term rental market. Think Airbnb, Vrbo, and the like. The government is cracking down.
And the new rule is blunt. As of January 1st, 2024, if you are operating a short-term rental in a city or province where it's not allowed, or if you're supposed to have a license and you don't, you lose the ability to deduct any of your rental expenses. All of them. Mortgage interest, property taxes, cleaning fees, gone. You report the income, but get 0 deductions.
So what happens if you were non-compliant for only part of the year? Maybe you got your license in July. Well, there's a formula for that. You just take your total expenses for the year, that's A, and you multiply that by the fraction of days you are non-compliant. So the number of non-compliant days, B, divided by the total days you rented the property, C. If you were non-compliant for the entire year, B would equal C, and your non-deductible amount would be 100% of your expenses.
And that brings us to the end of our lecture today. I want to leave you with this final question to think about as you review your notes. Reflecting on everything we've talked about, what do you think is the single most common mistake people make? I'll give you a hint. Mastering the difference between a current and a capital expense is probably the single most valuable skill you can develop in this area. It will serve you well. Thanks, everyone.